Okay. So this is going to be going over net present value on how you'd make a decision if it makes sense to buy a home or not. And so the class has asked us to look up 5-bedroom homes in San Jose and figure out if it would make more sense to rent or buy, and what that net present value of those home payments would be versus the rent payments, and if we'd have a buy or rent decision. So let's look. So we can, I've always used data. So it's San Jose, Redfin. Redfin is a pretty good market. Home prices are valued at whatever people are willing to pay for them. So we'll look now and we'll try to find a 5-bedroom home. Is San Jose. There's no 5-bedroom homes I've seen so far. Maybe oh, here's our first 5-bedroom home. We're looking at a 5-bedroom home here is $1 million. So I'll just take the first one. 1.44. So I'll just add that to my calculator, right? So total cost. $1.444. So we need a 20% down payment. So you'd need about $288,000 down payment for this. We need to know, I think this tells us what our rent would be for a similar property. What could rental estimate? So here, the average rent is $45.50. So as you can see, we get a lot of data online, which is great. So rent for a similar property is $4,550. And then we can say, what is the rate of return on SP 500, the stock market? The average rate of return right now is 9.8%. So we'll just say that if we invest in the stock market, we'll get something similar. So we want that to be our average rate of return. So San Jose, 5 bedrooms, total price is 1.4, down payments this. So the question here, we have some other payments associated. What would our mortgage be? This will calculate our mortgage for us. Let's see, where is that home? This has a mortgage calculator, I think, on it, which you can decide. Home price, down payment. So there's a few cash flows here, and we'll assume we'll sell it at the end of its life. So 1.4, 288. We did the down payment. We're saying the mortgage at a pretty low interest rate would be $6,500. Let's call it, and that includes property taxes and insurance. So okay there. Mortgage. 6,500. Luckily, some of that mortgage is going to include our principal, which is money we'll get back at the end. So we can actually exclude that, I'd say, from the mortgage. And so I'll just take the average principal. That's not how it works, but we'll take the average principal. This divided by 30 divided by 12. So we'll say paying back some of our principal, about $4,008. That's our interest. And so question is 30 years. What are our cash flows here? Cash flows here, and we'll assume we'll sell it on year 31. So first year, we have our down payment, and then we have our mortgage. Well, let's do the mortgage is, where's the mortgage? I'll do the full mortgage. Give us a better calculation because we'll assume we're paying both. 6,500, but we normally would have to pay rent anyways. So we'll keep that in mind. We'll say our mortgage is 6,500, cash outflow. For 30 years. And then our last piece is, what is this home going to be worth? Oh, 6,500 We got to time this by 12. 78,000 a year. So 78,000 a year. What are our total cash? So first thing we can determine, what is our total cash we're paying for this home? We're actually paying almost $1 million more because of the interest over the 30 years, right? But then what is our cash inflow? We can figure out what is average property increase. It'll give us the median price has increased 2.6 over the 12 months. So we'll say our value increases about 2.6%. You can always get better metrics. 2.6%. And so first thing, we have to figure out our future value equals future value. Future value of future value, and I think our rates here of this. And we should give a number of years. Let's see, future value. We can always search that up. Future rate, number of periods, payment amount. So this is how you'd search for it. Our rate is this. Our number of periods is 30 years. And our payment amount was there. Oh, no, it's not payment. It's not a payment. It is a present value. So the home we expect it to be worth, this is just calculating, if we expect the market to increase 2.6 for the next 30 years, this home will be worth about $3 million in the future. And so now we can determine, based on all these cash flows, what is our net present cash flow? So we can use some of these metrics we learned. Net present value, and we can also use internal rate of return. Right, so net present value is this times by our rate of return, or I think it's the rate of return first for this formula. NPV. That's our net present value here. So we have a negative net present value of $787,000. So that's to say that if we were to invest in the stock market at a 9.8% rate, we would lose money if the whole purpose of this was to sell. Our internal rate of return would be, we just do this. It's just that. Pretty low. Our internal rate of return is about less than 1%. But what we haven't taken into consideration here is we would have to pay rent anyways for this property. So, and that's where we kind of get this into this decision-making process. So let's say we were to calculate that, well, the rent, yearly rent on a similar property would be $54,600, right? So that money would be out the door anyways. And so our mortgage, we can assume, we can change all these calculations up and do the same rate of return, but we can assume that we are actually putting equity in of $23,400, right? Because that money would have been spent anyways. It was what we call a relevant cost in our managerial accounting, right? We're going to do the same increase in property, same property value, but now we'll do this. But instead of us choosing negative 78,000, we'll choose the negative 23,000. And then we can figure out, okay, what is our rate of return for this? Now we have a rate of return of about 5%. So that's better, right? We're spending the money, we're determining the money we spent beyond what we would originally spend, 5%. But our internal rate of return, what we're hoping for, is still a higher rate, right? We want we'd get 9.8% in the market, so we'd still lose money here. And so, what would this tell us about the real estate market? It would tell us that we would expect the real estate market to go down eventually for these higher value homes. That this is too high of a price because we could invest in the stock market and make more money in the future. So it tells us either A, that, or B, that people are expecting the increase of properties to be much higher. And that's why people are investing in this in the future. But looking on the face, if we're just to use net present value formula, we wouldn't buy these homes here. Or that also going to be telling us that people are expecting the rate of return of the stock market to drop significantly in the future. I think these are a lot of estimates. Generally, you wouldn't make these decisions. So I can show you, what if we bought a more reasonably priced home? So let's look at a townhome, right? You can see if this would be a better investment. So let's say, and this is why net present value is useful. So let's look at this home. It's $630,000, right? 630,000. Let's look at a different price home. 630,000. 1, 2, 3. Down payment here, significantly less. Rent for a similar property, will show us down here. Rent. We can even take the lower estimate. We can say 3,000 times 12. So 3,600, 36,000 for rent. We'll use the same rate of return. And what is our mortgage on this thing? I think let's see, mortgage. $3,311 times 12. Mortgage is pretty significantly less, right? We're looking at a home almost half the value. Total cash paid here. Let's see. Total mortgage, total cash paid. A little over 30 years. So mortgage is 39,000. Let's see. We'll do this valuation again, future value. Let's see. Increase in property, we'll keep the same. And this is all in the same area, right? So this property will be worth about $1 million in the future. And then our down payment is here. And so we have all the facts we need: internal rate of return, net present value. Again, this is pretty low because this assumes that we wouldn't have to pay for the rent. So I'm going to say exclude rent. Let's include it, but let's assume we'd have to pay for the rent anyways, right? So we can change the mortgage up and say the rent for a similar property is actually about 36,000. So our mortgage is the difference for our mortgage is only about 3,000. So let's say, is this a worthwhile investment? We'll do the same things. We'll just change it up. Here, except we change this to so here we get a lot closer. We get about a 6% internal rate of return. And so, and that's if we use a lower end of the rent, right? And so here we see this gets to a lot more reasonable decision making, and we can see, we can ask ourselves then, hey, when is this actually a buy? What is the housing? What should it be worth? And so we can play with this. Let's see. Oh, my calculation. The mortgage would change too, but we could play with this calculation to see, well, what should be the value of the actual home, right? What should I actually be paying for this? And so our net present value here is, what do we think that would bring our IRR to 0? And so let me play with this a little bit. So what if we brought this all down to 0? Still, we need to make some kind of return from the house, right? So even if we were able to rent out this house for the same as our mortgage, so our rent for the similar property wound up being the same as the mortgage. If, let's say, 0 it netted out, you still wouldn't have a rate of return that beat the stock market, but you'd start to get to a pretty decent rate of return of 8%, which I think is a nice target. You probably wouldn't get to a better spot until you actually, let's say you netted out and probably got a closer to a $500,000 home. You probably, yeah, 300,000. And then your property value wouldn't go up. I think that's the challenge here nowadays in the real estate market. I mean, this is an interesting exercise that you're hearing a lot of people saying that it's actually better to rent in today's market. And I think that that's not a false statement if you're looking at these scenarios. The one thing we didn't take into consideration is that, let's say the rents do increase. And so we could assume that, let's say we assume rents increase by and the same rate as the housing increases at 2.6%, you might get a little closer to this number. So that could make a difference as well. But this is kind of showing you that a larger home is in this market is likely overvalued. So what is this fact teaching us? A, that larger home is likely overvalued in San Jose. B, what it's showing us is that San Jose, if we were to go on the lower end market, you could probably still get a pretty decent rate of return, but it probably won't match the stock market if we look at comparing to historical rates of return, unless we assume that rents will drastically increase over the next 30 years, which is very possible and wasn't built into this model. But we can continue to build out this model and determine the differences. So that's a little background on how you can use net present value in your daily life for buying houses. Let me stop. Any questions here? Hopefully that's helpful.
The calculation is helpful.